Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, UK government borrowing surges to an £18 billion 5-year high, rattling gilt markets and signalling major tax hikes ahead. We'll analyse why this fiscal deterioration matters now and how it could impact the pound's trajectory and the Bank of England's policy. Second, Fed's Kashkari calls for more rate cuts despite 3.1% inflation, signalling a high-stakes philosophical battle inside the central bank. So we'll discuss why a top official is advocating for easing and what it means for the Fed's credibility and future rate path. Third, a jaw-dropping £15 billion AI investment plan for Scotland highlights the UK's infrastructure boom and a looming energy crisis. This discussion will reveal how this AI investment surge intersects with the UK's regulatory strategy and its looming energy grid constraints. The UK government just posted a borrowing number that sent a jolt through its finances, £18 billion in a single month. That's the highest August borrowing figure in 5 years, blowing past what analysts had predicted. And the situation gets more concerning when you look at the bigger picture. Over the first 5 months of the financial year, total borrowing has hit £83.8 billion. That's a staggering £16.2 billion higher than this time last year and already well above the official forecast. A while back, we talked about the main economic engine stalling while smaller, high-powered engines like AI and fintech were still firing. Today's overshoot doesn't contradict that. It shows the strain has migrated squarely into the state's balance sheet, even as parts of the tech economy keep humming. Now, the thing is, a single month's bad number can be dismissed, but a persistent overshoot like this is what makes economists and investors nervous. They start to wonder if this is a sign of a structural problem, meaning the UK's financial foundations are getting weaker rather than just a temporary dip. This is a lagging indicator, but it signals future trouble. So what's causing the bleed? Despite rising tax receipts, spending is surging. Interest payments on government debt alone jumped to £8.4 billion for the month, while welfare spending also climbed. And the debt interest is where it gets particularly tricky. A large portion of UK government debt is held in what are called index-linked gilts bonds, where interest payments are tied directly to inflation. So when inflation is high, the government's interest bill automatically skyrockets. This creates a dangerous feedback loop. High inflation leads to higher debt payments, which worsens the deficit and complicates the Bank of England's efforts to fight inflation. A few episodes ago, we said the budget would be the crunch point. This all puts the Chancellor, Rachel Reeves, in a massive bind. One analyst warned this highlights the deteriorating nature of the public finances. The opposition's shadow Chancellor, Sir Mel Stride, was even more blunt, stating the Chancellor has lost control of the public finances. To meet her own non-negotiable fiscal rules, economists now estimate she'll need to find tens of billions. One forecast suggests she'll have to raise £28 billion, mostly through higher taxes. Another analyst says the hole is even bigger than their previous £20 billion estimate. So the numbers have narrowed, but the direction of travel hasn't improved. Here's something that often flies under the radar. One of the most powerful ways to raise this money is through stealth taxes, particularly fiscal drag. It works like this. The government freezes the income levels for tax brackets. As wages rise with inflation, more people are silently pulled into paying more tax, even though the rates haven't officially changed. This directly squeezes household income, which could choke off the consumer spending that's been holding up the economy. And as we flagged before, the prospect of higher taxes tends to push firms into a wait-and-see mode. The markets are already reacting. The pound fell while government bond yields are on the rise. This is the market pricing in higher risk. When we place UK government bonds, or gilts, alongside safer ones like German bonds, the widening gap in yields shows that investors are getting more nervous. A sustained rise in this risk premium is a big deal. It can weaken the pound, making imports more expensive, and it makes it harder to attract the foreign investment the UK needs. This whole situation presents a fascinating duality. On one side, you have a surprisingly resilient consumer, and on the other, a severely strained state. If policy uncertainty and stealth taxes hit just as consumers pull back, that countercurrent of strength in tech we mentioned earlier may not be enough to offset the drag. A key indicator to watch will be consumer confidence and retail sales data. A dip there could be the first domino to fall. Speaking of governments grappling with tough economic choices, the debate inside the US Federal Reserve is getting really interesting. A top official is now pushing for more interest rate cuts, even as inflation runs well above the Fed's target. Minneapolis Fed President Neel Kashkari is advocating for 2 additional rate cuts this year. This comes right after the Fed just approved a quarter-point reduction, and it puts Kashkari in favour of 3 total cuts for the year, 1 more than he previously wanted. To really get what's happening here, you have to understand the Fed's dual mandate. Its 2 primary goals are maximum employment and stable prices, which it defines as 2% inflation. The tension you're hearing about is these 2 goals pulling in opposite directions. And this is where the situation takes a more complex turn. Core inflation is running at 3.1%, a full point above the Fed's 2% goal. This raises a critical question. Why push for more cuts when inflation is already hot? Believe it or not, this could signal a subtle but profound shift in the Fed's strategy. Some economists call it an opportunistic approach to disinflation. The idea is that instead of crushing inflation with high rates and risking a recession, the bank tolerates slightly higher inflation and waits for an economic slowdown to bring prices down naturally. It's a high wire act because it risks the Fed's long-term credibility. Kashkari's answer is a direct challenge to conventional wisdom. He believes the inflationary impact of tariffs will likely be just a one-time effect. The tariffs in question are primarily those on Chinese goods. Kashkari is essentially saying that while these cause an initial price spike, they won't create a persistent cycle of rising inflation. Research from the Fed itself suggests that for every 20% tariff, consumer prices rise by about 0.33 percentage points, a one-time adjustment, not an ongoing force. This allows the Fed to look through the tariff impact. He's pointing to a weakening labour market plus easing housing and wage growth as justification. We previously analysed those downward revisions to payroll data, early cracks that set up today's argument. But that weakening labour market deserves a closer look. While some indicators have softened, others remain strong. For instance, the SARM rule, a trusted recession indicator, hasn't triggered. It's the key here is that Kashkari is being forward-looking. He's concerned the labour market could weaken rapidly and is advocating for proactive cuts to support employment, even if it means tolerating higher inflation for a bit longer. And on the point of easing housing, that's perhaps the most important pillar of the argument for rate cuts. It's all about a component of inflation called owner's equivalent rent, or OER, which makes up a massive 25% of the main inflation index. The wild part is that OER is a lagging indicator. The Fed is betting that the cooling we've already seen in the rental market will continue to show up in this data, mechanically pulling overall inflation down. If that trend stalls, the entire case for cutting rates falls apart. Now get this, in a quote that perfectly captures the tension, Kashkari stated directly, "We're not okay with 3% inflation." He sees the problem, but still lands on more rate cuts as the solution. This really gets to the heart of the philosophical battle. By advocating for cuts while inflation is at 3.1%, he's revealing a preference for a higher inflation tolerance than the official 2% target suggests. The Fed's benchmark rate is currently between 4 and 4.25%. Kashkari, who doesn't vote this year, is publicly signalling a deep division. Why say this now? Because essays and interviews from influential non-voting members like him act as a leading indicator for future policy. His words can steer the consensus and create a path of least resistance for the committee down the road. The core conflict is no longer just about the data. It's a high-stakes philosophical battle inside the Fed. So what should we watch? Keep a close eye on that owner's equivalent rent data. And second, watch the job market reports. Any sharp decline will strengthen the case for easing. We were just talking about the high-level policy debates shaping the economy. Now, let's shift to the physical world, where a massive investment in AI infrastructure is raising some very different questions back in the UK. The most unexpected news in the finance world today has to be the £15 billion bet being placed on the small Scottish town of Irvine. The goal? To turn it into one of Europe's largest artificial intelligence infrastructure hubs. The plan is being fronted by a company named AI Pathfinder, which is kicking things off with an initial £385 million investment. Local officials are already calling the project transformational. However, if you zoom out, you'll see another layer to this. These kinds of headline-grabbing multi-billion pound investment announcements are often what economists call a noisy leading indicator. They're great for headlines, but research shows that historically, only about 60% of the initially pledged investment actually materializes as planned. But that's not the whole picture. The real turning point is when you look at the backer, AI Pathfinder. It's a subsidiary of a London property developer with a limited track record in AI, and that staggering £15 billion figure is a long-term ambition. Some observers are calling unbelievably large. Now, here's why that's a red flag. Projects of this magnitude, especially data centers, are incredibly capital intensive. Securing financing is a major challenge, and that's before you even get to power constraints and land availability. As for the transformational claim for the local economy, there's a critical question. Will the jobs created match the skills of the local population? The UK's data centre industry is already facing a skills crisis and an ageing workforce, which suggests that without targeted retraining, many of these high-tech jobs might have to be filled by talent from outside the region. And yet, this is more than just hype. This announcement is part of a massive UK-wide investment surge. BlackRock is expanding in Edinburgh. Amentum is injecting £150 million, and CoreWeave is building another major AI data center. So what's really driving this? It seems to be a deliberate policy choice. The UK is strategically positioning itself as a lightly regulated data hub, a third way between the EU's strict AI Act and potential US rules. This pro-innovation approach is very attractive to international capital. This decision brings both huge potential and comes with inherent risks. We're seeing audacious promises, while at the same time, a tangible tidal wave of capital from major global players is already hitting the ground. This isn't just about one project. The UK is aggressively being positioned as a key global hub for AI infrastructure, but building this physical backbone comes with a colossal hidden cost: energy. The exponential growth in energy demand from new data centers is set to test the absolute limits of the UK's power grid. In fact, the CEO of the UK's national grid stated that power demand from data centers is projected to increase sixfold in the next decade. A sixfold increase that could force very difficult trade-offs between industrial policy and climate goals. The stakes are immense. So what to watch for? First, the British pound. A sustained surge in this type of investment could strengthen it. More critically, watch the UK's energy prices and grid capacity reports. Any signs of strain, there will be a leading indicator of whether this AI boom is sustainable. Finally, pay attention to local skills reports to see if the workforce can adapt and capture the benefits of this AI gold rush.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.